Accrued expenses refer to costs incurred in one accounting period, but paid for in a different accounting period. A common example of this is payroll processed in January for the last week or two of the prior year. To record such expenses, a journal entry must be made in the relevant accounting period to reflect the expense, even if the payment is made later. For instance, if a payroll is taken out in January 2024 for the last week of 2023, it is still considered a 2023 expense and must be recorded as such. To do this, a journal entry is created with the date of the last day of the accounting period. In this case, December 31st. The entry would include the payroll expense, which could be broken down into salaries, bonuses, and payroll taxes for more detailed accounting. However, for simplicity, a single expense account can be used. The corresponding account for this entry is typically called accrued expenses or accrued liabilities, as it represents a liability for the current year that will be paid off in the following year. Once the journal entry is saved, the expense will appear in the profit and loss statement for the relevant year. Nevertheless, this entry is temporary, as the expense will be paid in the next accounting period, and duplicating the expense must be avoided. To prevent this, the entry must be reversed as of the first day of the next accounting period, when the actual payroll payment is made in the following year. It can be recorded as a normal payroll, without duplicating the expense, since the accrual entry was previously created and then reversed. This process ensures accurate accounting for accrued expenses and prevents errors in financial reporting.